Welcome back to That Money Guy, and today we'll be talking about credit card basics. So, what is a credit card? A credit card is a card that you use to borrow money. It is based on your credit score, which is a way for lenders to know how risky it is to let you borrow money from them. The higher the score, the better. It ranges from 350 to 850. So if you have an 850, you're golden. Low credit scores are those like under 650. If you have a low score, it makes it harder and more expensive to borrow money to, say, buy a car, maintain insurance, home mortgage, phone plans, renting apartments, and so on. And so, if you want the best deals and the lowest interest rates, you need to have a better credit score. In 2012, there was a study conducted by the Society for Human Resources Management that found that 47% of employers use credit checks as part of their hiring process. So, a credit score could also affect what jobs you get. So, your credit score, also known as your FICO score, is based on five main factors. First and foremost is your payment history. So, if you pay on time or early, which is better, and if you pay in full, so if you pay all of it. And so it's just like how often you pay your bill on time. And amount owed, which is 30% of your credit score, is how much you use on your credit card. So say you have a $1,000 card limit, so you can't spend more than $1,000 on your credit card every month, then you want to not spend more than $300, because if you spend more than 30% of your credit card limit, then your score starts decreasing. This is called the credit utilization ratio, and you really want to keep that low. So if you pay early, for example, then you have a lower utilization ratio. And then the length of credit history, so how long you've had the credit card accounts, also affects your credit scores. So the longer you have a credit card or any loans, the better, because you have a longer credit history. And then 10% is based on new accounts and increase. So each time you apply for a new loan or a credit card, it can slightly decrease your credit score because you're asking for more money to borrow. This is known as a hard inquiry. You want to try to limit those. So wait at least 6 months before applying for a new credit card or loan at the least. And then types of credit is the different loans or credit cards you have. So if you have student loans and then a car mortgage and then a home mortgage and then a credit card, then you have different types of credit, and that helps your score. Also, in 2019, they started a new credit scoring system called the Ultra FICO, which I've included below if you want to learn more about that. It's being pilot tested right now, and it benefits those with little credit card history, so new customers, and those who are rebuilding their credit because they've gone into bankruptcy or had bad credit history in the past. So if you're just starting out and you've just turned 18, you can apply for your first credit card. You can also ask your parents or someone that you really trust who has a good credit card history to become an authorized user. So that way you can begin earlier and get their credit card history for you and make it work for you. So say your dad has like a score of 850, for example, you can ask to become an authorized user on his account, so that way you can get his credit card history, and that can help you build your score from an early age. You can start doing that at age 13 to 16 depending on the credit card company. American Express, for example, starts at age 13. However, this is a really big decision, and there's links in the description below that describe the process and if this is the right course for you or your parent. Also, you can Google like best credit cards for students and look up like lots of different student cards once you turn 18. And starting your first year in college, for example, it's a really good time to build credit. This is Discover. It has many different options for students. The Discover It Chrome for students earns 2% cash back at gas stations and restaurants on up to $1,000 in combined purchases each quarter, so every 3 months, and it earns unlimited 1% cash back on all other purchases. There's a link below if you want to sign up for this card. That will give you $50 extra for signing up. Also, there's the Discover It Student Cashback, which earns 5% cashback on different places like gas stations, grocery stores, and restaurants. But those categories change every 3 months. So you need to check the calendar and see if you can actually like get more rewards than say this one, the Discover It Chrome for Students. And also, let's just like look at more details. So like learn more. If you look at this, it says no annual fees, so you won't be charged every year for the card. So make sure to not get a card with an annual fee, especially when you're first starting. Sometimes they charge annual fees because they have better like rewards, but especially for when you're starting, you really don't want those annual fees. They also provide a good grade reward, so you get $20 statement credit each school year. Your GPA is 3.0 or higher. So this will lower the payment that you have to make to your credit card by $20. And there's a cashback match the first year. So this is a sign-up bonus. They'll automatically match all the cashback you've earned at the end of your first year. So say you've earned $100 in cashback, they'll double it by the end of the year. You'll get $200. You get your FICO credit score for free. So once you get a credit card, most companies let you access your credit score for free. You won't get a credit score until you've had the card for at least 6 months. And there's an intro APR. So there's an starting interest rate for the first 6 months. It'll be 0%. So if you pay late or you don't pay on time, you aren't gonna be charged for that until after 6 months has passed. So after that, it's 15.24 to 24.24%. So after those 6 months, you will get charged an interest rate for any bills that you don't pay on time. So if you don't think you can pay on time, then don't spend the money. Make sure to always pay on time and pay in full so you never have to pay interest. So I'm going to click on See Rates, Rewards, and Other Info. Here you can see the intro APR, the APR for cash advances. So if you go to an ATM and withdraw cash with your credit card, you will be charged 27.24% starting on the very day that you withdraw money. So never withdraw cash with your credit card. A balance transfer. So if you have another credit card or another balance on another credit card, you can transfer that over to this credit card and get a better rate, for example, because the intro APR is 0% for the first 6 months, so you won't be charged interest on the other balance that you had, but it will cost 3% of that balance in order to transfer that. So this is a way to like help people who need to lower their interest rate temporarily and rebuild their credit. There is no late payment fee for the first time you're late to your payment, but after that there's a $39 payment fee. And then if you don't have enough money in your bank account, then they will charge you $39 for having to return that payment to you. So make sure that you always pay on time and that you have enough money in your bank account to pay your credit card. And you can automate this so you don't have to worry about it. Also, for Discover cards, they have no foreign transaction fee. So that means if you use the card in another country, you won't be charged a conversion fee for that. So this is from Birch Finance, and it's describing when your credit card bill is due by Matt Bicknell. It describes the difference between a bill due versus the statement close date. So the date that the bill is due and the date that your statement closes are different and can sometimes be confusing. With credit cards, your purchases in a given time period are grouped in what's called a billing or statement cycle. So here you see that the statement start date is January 10th, and then you make purchases, and then the statement end date is February 9th, and the bill is due February 28th. So any purchases that you make between January 10th and February 9th are due to be paid on February 28th, which is the bill payment due date. And according to a new law passed, it's going to be the same every month now. So you don't want to make just the minimum payment, for example, here. So this is a credit card bill example. Here you see that the next payment due is August 26, 2017, and that the minimum payment due is $25. So you want to pay more than just the minimum payment, because if you don't, you're going to have to pay interest on anything that you don't pay. So here on your last statement from your last balance is $1,479.73. So you want to pay all of that balance in order to avoid your interest by the next payment due date, which is August 26, 2017. And here you can see that auto payment is on, so you don't have to think about it. It can just be automatically deducted from your bank account that you link to your credit card. As always, thank you for watching. Please hit that notification bell and subscribe. In the right hand corner, you can see my next video on the best credit cards out there. Make that money. Bye.